Obviously, Bitcoin hit new highs over the course of the year, but still things like Solana and Ethereum still haven't really broken to new highs versus the last cycle, which is confusing people. That sent me down a rabbit hole of, okay, what's really going on here? And the kind of foundational work that I did called the Everything Code was based on this 4-year cycle to do with the 4-year debt maturity of the United States and most countries. I redid the work and found out that in 2022, because interest rates got down to zero again in 21 and early 22, they restructured the debt to 5 years. So it's added another year. So we've got this weird kind of hybrid extra year that we've never had before. And we've seen that in things like the business cycle. The ISM survey gives us a guide of the business cycle.
Bitcoin has surged to new highs this year, but much of the rest of the crypto market is lagging. Ethereum, Solana, and other major coins remain below their previous peaks, making this cycle feel different from the all boats rise pattern of past bull runs. Many are asking why momentum isn't spreading. Has something broken, or are we simply playing by new rules? Raoul thinks the answer lies beyond crypto, in sovereign debt markets. His Everything Code theory links market cycles to the typical 4-year maturity of government bonds, but when interest rates hit zero in 2021-2022, governments extended much of their debt to 5 years. That 1-year shift quietly altered the macroeconomic rhythm, creating a lag in market energy. According to Pal, this could explain why altcoins feel sluggish. They aren't broken, they're just waiting for the macro clock to catch up. Once it does, the next phase of the cycle could arrive with far more force than expected, spreading momentum across the broader crypto market.
So yeah, I mean, this year's been a year I think that many people have so far found frustrating because everybody wants exponential price rises and every number to go up, and it's not been that kind of year. What we've seen in the background is this massive change in regulation in the US. So the background is incredibly positive. Passing of the stablecoin laws, we're still waiting for the Clarity Act to come through. We've seen pretty much every bank and financial institution, so they're going to build on blockchain rails. So we've seen the rise of the ETFs, the DAT. So we've seen this whole kind of Wall Street infrastructure build out on crypto. And you would have thought, had we have said this before, you'd say the number was much higher. Now, obviously, Bitcoin hit new highs over the course of the year, but still things like Solana and Ethereum still haven't really broken to new highs versus the last cycle, which is confusing people. That sent me down a rabbit hole of, okay, what's really going on here? And the kind of foundational work that I did called the Everything Code was based on this 4-year cycle to do with the 4-year debt maturity of the United States and most countries. And I redid the work and found out that in 2022, because interest rates got down to zero again in 21 and early 22, they restructured the debt to 5 years. So it's added another year. So we've got this weird kind of hybrid extra year that we've never had before. And we've seen that in things like the business cycle. The ISM survey gives us a guide of the business cycle. And people talk about this K-shaped economy where, growth stocks have been going up. But meanwhile, things like the economy have been relatively slow for normal people. And that's a function of this business cycle not picking up, rates staying high, and the fact that they didn't need to refinance the debts in massive size this year. But it all comes to next year. So it's been really a patience game of the sideways choppy market. But people forget also, last year was the same. Last year peaked in somewhere early in the year and then did nothing all year. Everyone got so frustrated. Everyone was flinging poo at each other online and getting angry with each other. And then before you know it, took off like a rocket ship in November and December. And I think it's somewhat similar this time around. And the rocket ship this time around is based on the fact that they've kind of not been adding liquidity into the US. That's the magic formula that drives the price higher, the debasement of currency. There's various mechanisms they use to add liquidity. The classic used to be quantitative easing, where they just print money and put it on the balance sheet. But this time around, they've not been doing that. They've actually been tightening. And so then they have this mechanism called the reverse repo and then the Treasury General Account. And these things they've been using. And what's happened is the government shutdown has stopped the government actually spending money, which means that they've held back and maybe $250 billion of stimulus that needs to come into the economy. So that, as soon as the government reopens in the next few days, we'll start to see liquidity flowing back in. Then we've got the Federal Reserve cutting rates. Then we've got the Clarity Act coming. Then we've got some changes to bank regulations to allow them to hold more reserves, and before you know it, the whole liquidity flywheel kicks off. Well, the stability is a double-edged sword. It's kind of institutional investors prefer the less volatile approach. It still does decently well, but retail investors who have their hopes and dreams in the power of the returns of crypto then get angry and frustrated that they're not getting those returns unless they've been very selective in what they've bought. There's certain things. I know the Binance token hit new all-time highs. Bitcoin did. We've seen this massive run recently in Zcash, but a lot of these things don't stick for very long. So what we found again is like this bifurcation where some projects have done really quite well considering the stability-based environment, but a lot of other stuff has bled 50% or 40% in the meantime. So it's kind of weird. So stability is a good thing because it attracts more institutional capital. It's a bad thing because it keeps retail away. So retail investors went to tech stocks instead because there were easier returns. So if we think about 2025, the issue is if the liquidity pie didn't grow, then these narratives, they catch traction, but it means other things don't because you're recycling the same money. Mm-hmm. So you keep recycling the money, and then before you know it, you're buying the highs and it collapses back down again until the liquidity comes in, and then you can anchor these narratives that are more pervasive and can last longer. So I think the privacy narrative makes a lot of sense considering where Europe and the UK has been so far in this whole crypto equation. They've been kind of very, very cautious. And so people are concerned about that and the central bank digital currencies and what they're trying to do with that. So I think this one lasts. Obviously, it won't go up in a straight line. It has done, but things need to correct. I don't know where the next narrative. There's always a narrative in layer one somewhere. What's the new, faster, getting traction layer one narrative, and then it feels kind of wide open. Often it starts with people look at cash flows and DeFi and say, well, this protocol's producing cash flows, and later in a bull market, nobody cares about cash flows. It's then super narrative driven. We've had the rise of hyperliquid. It's not yet clear to me where the next new narrative comes from. Maybe it just comes from the broad stablecoin adoption from the financial system and who's building on what chains for that. I think that's a big one. And again, I'm not really clear what the next narrative is until liquidity comes and the market will start to focus on, the core things. But usually in the latter part of a cycle, what you get is like a hyper focus of 5-6 things that go up a lot that really catch the market's attention and feeds on itself. But it's not yet clear what those are. And you don't want to believe it either because in the prior years, they go up and then they come back down again. You're like, really? I mean, it could be AI and crypto again, because that's not going away either. So, but we just have to wait and see. You see how this works is when the market goes back to new highs or near the highs, people recycle gains or their optimism into longer term assets, things like digital art. And so that happens. And as we came back down to the bottom of the range, we saw the digital art market slow down again. But as we start breaking, particularly Ethereum, 5,000, and let's say the big positions people have, stuff like Solana, once that starts really breaking new all-time highs, you'll see a lot of money getting recycled into these long-term kind of trophy assets. It's exactly the same thing that people do with watches. It's really interesting. It's all driven actually by the business cycle. So whether it's watches, fine wine, or digital art, they're all driven by the business cycle. So once people are starting to make money, have a bit of excess earnings, they recycle it into trophy assets. So that, again, lies ahead. Once we start breaking new highs, we'll see a lot more of this. And I think people are going to be really shocked at the price some of this art trades at. You'll suddenly start to see things like, a piece of digital art trading for $20 million. I mean, they've traded as high as 70 million in the past. But, these are big numbers, and we will see that all over again.
This year hasn't been the moonshot many hoped for. Prices have largely moved sideways, frustration is mounting, and social feeds have become battlegrounds of blame. While Bitcoin reached fresh highs, most of the market feels stuck in limbo. Yet beneath the surface, progress is quietly building. Stablecoin regulations are advancing, ETF frameworks are taking shape, and banks are inching closer to blockchain integration. On paper, this should have sent prices soaring, but instead the market has settled into a holding pattern, and it's starting to make sense. The cycle itself may have shifted. A delayed government debt rollover stretched the usual 4-year rhythm into 5, disrupting everything from business sentiment to crypto momentum. Combined with paused stimulus, installed liquidity, and retail exhaustion, the market has been simmering rather than sizzling. But power is quietly building. Renewed government spending, rate cuts, and updated banking rules could unleash liquidity fast, and when it returns, it floods rather than trickles. Stablecoins, privacy tokens, DeFi, and even NFTs are all primed for ignition. The next wave won't warn you, it will just take off. Raoul points to structural delays in liquidity, while Tom Lee emphasizes market fear and investor exhaustion. From macro stress to liquidation shocks, Lee captures just how fragile sentiment remains. Let's watch clips from his interview.
Well, Leslie, I think the markets are a bit nervous in crypto land and equity world because one, we've had a government shutdown, and then there's been doubts about AI valuations and people raising questions about that. So AI stocks have corrected and many growth stocks have corrected. And then in crypto specifically, it's been dealing with two issues. One is there was this big liquidation event on October 10th, one that really was a larger liquidation event than anything seen in history. And the second is because crypto is risk on, I think markets are really struggling with what the Fed's going to signal on December, because, you know, if you end up with a hawkish Fed, it gets crypto investors very nervous. I think that's all creating this downside pressure, but I think the good news is there are signs of exhaustion. I did speak with Tom DeMark of DeMark Analytics, and you know, he thinks there are signs that would look like a bottom that could be occurring sometime this week. You know, Ethereum is a smart contract platform, so it differs from Bitcoin, which is a store of value, and in many ways its virtue is that it's inert, you know, and it represents digital gold and a good store of value. Ethereum, on the other hand, is because it's a smart contract platform, is really the rails where I think a lot of things are going to be built. And one of the big breakouts this year has been stable coins, but it's also been things like prediction markets, and now talk about tokenizing more than just dollars, but equities and real estate and alternative assets and other assets. And a lot of that will be built on Ethereum or layer 2. So I think from a perspective of what the ecosystem looks like, Ethereum is a place where there's a lot of activity taking place, you know, and you can measure it by transaction volumes or transactions per second or even value locked on the chain. And these are all rising. So to us, I think it's a story that still is in the earliest stages, and one of the reasons we consider it a super cycle.
Tom, in terms of just the overall volatility, what are some of the near-term headwinds you're expecting Ethereum to face?
Well, one of them is the industry did suffer a big liquidation event that I think crippled many players and wiped out many accounts. So I think that this, just like in 2022 or in 2020, it does take a few weeks for the industry to sort of find its footing, and I think that's why crypto prices have lagged here. And it does have the signs of that maybe a market maker or two actually is unable to provide market liquidity. And as you know, as liquidity contracts, it's the same thing as the central bank tightening. So it's almost like crypto QT. I think the other thing the markets are grappling with is people talking about the 4-year cycle. Many are convinced that Bitcoin prices have peaked. So in some ways, Bitcoin being the blue chip and the bellwether is important for crypto, because if Bitcoin makes a new high this year, then it really obviates the fact that there is a 4-year cycle. And so it's, you know, to me, between now and year end, you know, I'm pretty bullish on stocks. You know, this sort of weakness in the first half of November was what we expected. But as markets rally, I think that's going to help propel Bitcoin to an all-time high.
I think we're nearing a bottom. I look at this as a great buying opportunity for long-term investors. You know, Bitcoin was the first thing to turn over before this broader market pullback. It was sort of the canary in the coal mine, signaling that there was some risk in all sorts of risk on assets. I think it'll be the first thing to bottom, and I agree with Tom, we're getting very close to that point. So I think it's an exciting opportunity, again, for people who are looking out a year or more into the future. I think it's a generational opportunity for long-term investors, whether you're looking at Bitcoin, Ethereum, or Solana. To double down on what Tom said about Ethereum specifically, look, I think investors are very nervous broadly about the economy, about AI valuations, about tariffs, about the broad economy. You want to look for secular trends that are decoupled from that. I think regardless of what happens on the economy in the next year, stable coins will grow tremendously. I think regardless of what happens, tokenization will, maybe 10x in the next few years. Prediction markets are going to be huge. Decentralized identity and digital identity are going to be huge. Ethereum lets you play those secular trends, which are in this enormous growth phase, almost regardless of what's happening in the broader economy. So for me, it's really it's a generational opportunity, and to get in at these prices, I think really is almost a gift for long-term investors. It's a tremendous opportunity.
Crypto markets have been tense, weighed down by a government shutdown, inflated AI stocks, and October's record liquidation event. Investor sentiment is fragile, and all eyes are on the Fed's December meeting. Hawkish signals could hit risk assets, with crypto reacting first. Beneath the surface, however, signs of exhaustion and a potential local bottom are emerging. Ethereum and its ecosystem continue building, while liquidity remains the missing ingredient. With expected stimulus, rate cuts, and evolving banking rules, sidelined capital could soon ignite rapid price move. Bitcoin is key. Reclaiming a new all-time high before year-end could shake the notion of another 4-year cycle and energize the market. This slow, uncertain phase may just be a setup for the next major move. So, which story fits best? Raoul Pal's liquidity thesis or Tom Lee's sentiment-driven view? Share your thoughts. For more Daily Dose Crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.